three US market indices. A big moving day on the markets, not only in the US, but really around the world, largely expected. We've been talking about this for a number of weeks leading up until what we were describing to be that of the intermediate top of this market, albeit temporarily. And really Friday through today's session, we have seen quite a material retracement. Today alone, the NASDAQ, as at the close on Monday, it was down 2%, in addition, of course, to that outside day engulfing Marubozu candlestick that we were left with last week, whereby we saw definitively that ADX turn down. The video was titled, The Buckles Come Off the ADX, and I've put out a number of warning videos over the past number of weeks describing exactly what is happening in the market at the moment. It's largely unexpected, as I've already alluded to. Now what I'm going to do is walk you through obviously what we believe is going to happen now that we've begun to see that of this material pullback, this correction in the market, whereby again, we're still expecting this market to take out these swing highs. However, the market itself, it needs to rest. It needs to naturally correct. The question becomes right now, how deep and how far is this correction going to go? And also, how long is this correction going to last? Now, we've got a little bit of evidence to actually help us in answering a couple of those questions. Number one, of course, is that during, or at least the difference between that of the closing price on Friday and where we've closed at today, it's now left us with, again, another open window. So essentially right now, I'm looking at the market operating, or at least moving in the following two paths, or along two different directions. First of all, these markets may very well rally to close this window. That is probably most expected this particular time. We didn't actually see the markets rally off from or towards the end of the session to really close all that strongly. It was a pretty weak sort of close as well. However, generally what happens after these gap downs, these very sort of quick movements, you'll see the markets rally. It's like a vacuum, an exhaustion gap, whereby you'll see price action move and fill into the gap to close it, upon which you'll see a secondary reaction sort of resistance area show up at a lower area to where we have been in regard to this intermediate top, which sets up, if I can just illustrate this for you, a little bit of a leaning double top. So I'm just going to try and illustrate this. We get the gap down, we get the rally, we get the sort of the ceiling somewhere close to the low of Friday's candlestick over here, upon which it sets up the slanted double top. And then, of course, you see the continuation of the correction. So as the markets rally, people are going to tell you that that's it. It's all done. It's all over, until a point whereby the market's pushing up, in particular NASDAQ, generally up to say 9,300 or 9,350, whereby the handbrake is pulled once again. And then you see the natural rollover, upon which we'll take out wherever we actually base, or where we have based during today's session, if we see this quickly play out as at Tuesday. That is really portal number one. That's what you should be thinking about, all right, at this particular junction. Number two, however, is that we move into more so of a cascading waterfall sell-off, whereby instead of actually stopping and basing right here, and there's no actual evidence that we are going to do this, however, what we could just see is the bottom continue to fall out of this market, whereby again we go negative year to date very quickly and very easily, not only on the Dow Jones, which was established during today's session, but also following or flowing into that of the S&P and also the NASDAQ. Again, we've only had 2 days of this sell-off at the moment. Most of the gains of 2020 have been given back very quickly. And again, there's no 100% guarantee that the markets themselves are going to stop. They are going to stage a rally, upon which there's the next selling point over here. So we'll see what happens. Personally, I think we're going to get this outcome, right? A little bit of a relief rally, whereby a lot of people are sort of taking a breath of relief anyway. However, it is going to be temporary, whereby we ultimately take out this swing low. Volatility at the moment, it is quite high. Obviously, the VIX positions have worked out very well. There's also sort of synthetic option trades that people have been taking, which is fantastic and have been brought to my attention. I know personally people are up over 40, if not 50% already in the space of about 4 days on those trades. But this is just to show you the volatility spike in the markets as the markets have pulled on back. So again, counter to actually trading against the direction of the trend, which is predominantly to the upside, and it has been since that October breakout. What people have been doing have been strategically front-running the spike in volatility in options, which is fantastic because, again, you have been paid off quite handsomely. But the problem is, or at least not the problem, but the conundrum right now is that if the markets do stage rally, the VIX or VIX contracts, right, they're going to sell off, or at least they're going to pull back temporarily as well. So again, just a couple of trade ideas very briefly, but it is more so going to be sort of contained to Pivot Point Pro as we move into the week upcoming, and obviously into that pro analysis class this coming Saturday, is that if you do see the markets, right, stage that rally, see the reversal candlesticks, maybe see some shooting stars, hangmans, outside day engulfing candlesticks somewhere towards the base of Friday, session, it's another opportunity to say that if you've liquidated your positions over here or during today's candlestick, maybe you do it even on Tuesday, it will be another opportunity that if you have missed out to actually lean on into that trade again and just rerun the situation, because you're going to see the continued sell-off below the low of wherever this mark is if we do not see, of course, just the continuation of the cascading waterfall sell-off. So I just wanted to run that by you as well. Obviously this week, and we made we made this point very clear, is that in our top 12 individual trade list over here, we've got a number of companies set to report. This is going to add to the volatility that we're seeing in the market at the moment. Apple is one of those companies. We've also got Amazon later in the week, Boeing Airlines as well set to report. Not Baidu this week, however, Caterpillar is set to report in the final trading session of January 2. COP is pushed out into Feb, so is Disney, Google into February as well. IBM has reported along with Netflix, and the final company, which is going to be a big one this week as well, is going to be Microsoft. So again, don't think that volatility has completely left the markets. It's still going to linger. We're going to have to see the reaction to these earnings reports, but really the update as at Monday afternoon anyway is just to alert you that, look, we're in the midst of this intermediate correction, something that we've been speaking about here publicly on the YouTube channel. It's good that it's finally come, because what that means is ultimately when this market does base, right, it's going to be another platform. It's going to become another opportunity to strategically enter into this location like we did throughout the majority of 2019, whereby we go through that sort of harsh period whereby a lot of people are caught out. They believe that something like this cannot happen. They drink the Kool-Aid a little bit on the bullish narrative of the market, which is fine, because ultimately they are still going to be right on the macro time frame. However, what happens is they fail to actually interrelate the different fractals of the market itself. The macro working in conjunction with the intermediate, and the intermediate working in conjunction with the minor level of the trend as well. We're firmly in an intermediate top for the markets right now, and this is now the buyable correction whereby we start to push a couple of percent away, probably somewhere in the vicinity of 10% from this swing high top over here. But we're going to monitor it. First of all, we need to see how this market reacts on Tuesday to see whether we get the pop and then the sell-off, or whether or not we're just going to continue the sell-off down below that of Monday's candlestick here. I don't think that we've seen the end of the selling, so don't think that you need to jump into the market first thing Tuesday and secure your net long position again. Just simply sitting back, just watching it, trading volatility, and in the meantime, strategically looking for options and I guess little hints and clues as to when it's a good opportunity to re-enter into the market. Very quickly, I just wanted to show you this on the NASDAQ. As the NASDAQ sold off 2% today, ADX is falling off a cliff, so is the CCI, which is what should be happening. Again, if I flick on over to the S&P 500, ADX turning down, CCI falling off a cliff, and the Dow Jones Industrial Average, the same is true. Now, market here, yes, the ADX is trying to turn up. It's not telling us that it likes the bullish side of or the directional movement. It's telling us that it likes the bearish side now. So again, you can flip back and forth, bullish and bearish, depending on the strength of the move. And if anything, it's really substantiating that of an intermediate correction based on what the ADX is doing during today's session, and also where it began off from, given that of Friday last week, what we saw that outside day engulfing Morobozu candlestick, which really alerted us to, again, the potential that the actual correction was imminent. We're in the midst of it now. And above all, I hope that you have been, or at least have the sort of the self-discipline to sit on the sidelines and just to wait for this opportunity to come. Because again, the exciting thing about this is that we are going to begin, right, allocating capital back into the market at discounted prices, probably whereby a lot of people, unfortunately, are going to be selling into the weakness, will simply be buying, right, and taking the opposite side of the trade, knowing that the market is going to stall out, it'll stop, it'll exhaust itself, and then we'll slowly grind on up and take out this intermediate swing high over here. So again, strategically, it's a good place to be if you're not in the market. If you're just holding fixed positions, it's a fantastic place to be, because right now we're getting closer to allocating capital back into positions, not only in our top 12 trade list, but also on the extended markets as well. Very quickly, I just wanted to show you this. We picked up on this exactly, or I should say, immediately when this began to happen. We called out the transportational average at 11,344. This has been a target for quite some time. And again, I started to speak about in the weekend video just gone, the recessionary sort of narrative that you're going to naturally hear now that the transports haven't produced out of a subsequent higher high. Like the industrial average, the S&P and the NASDAQ, you can see the transports turning down quite aggressively. If you wanted to take this one step further, if I can bring up the right chart, I need to put the dollar sign in front of RUT. You can see also we called this almost to the penny at 1,701. Again, similar to the transports, we still haven't produced a higher high on the Russell 2000 either. So the deeper we go, you're going to hear people talking about how, or at least they're going to blend the theory of Dow and say that we're not seeing, right, participation in market breadth. That participation, it's going to come. However, it's probably not going to show up for a number of months into the future. So again, as the Russell pulls back, I've been trying to alert people and warn people about this coming, I guess, discussion point that you are naturally going to hear. I haven't read anything about it yet, but it is going to show its face over the next couple of weeks, if not a couple of months. Please do not buy into it. A big exclamation point. Please do not buy into it. That's why I'm front running this for you. I'm telling you it's coming. Don't find yourself believing the news stories that you read about Dow theory and how we're not seeing confirmation. Yes, technically it is true through to the current juncture. However, that will shift and it will change. And ultimately, we will see confirmation between the Russell and, of course, the NASDAQ, the industrials, and also the S&P 500. But that's going to come post this intermediate correction that we find ourselves in at the moment. So I'll keep you updated on that. In the meantime, have a look into that pro analysis class. That'll do us for Monday, everyone. Enjoy your Monday evening, and I'll be back with you later in the week for some more market addresses. We'll see which of the two paths these markets take. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Farewell.